Bitcoin ETFs just crossed $100 billion in assets, and Wall Street is celebrating like they invented fire. Meanwhile, every single person buying these ETFs is making the exact same mistake that cost people billions when FTX collapsed. They think owning an IOU is the same as owning the actual asset. Spoiler alert, it's not. And the difference could cost you everything. This is purely educational content, not financial advice. Do your own research and make your own informed decisions. Look, I get it. Bitcoin ETFs are convenient. They're in your brokerage account right next to your Apple stock. Your financial advisor can finally stop looking at you like you're insane when you mention crypto. You don't have to learn about wallets or seed phrases or any of that scary technical stuff. But here's the thing. Convenience is exactly what Wall Street charges you for. And in Bitcoin's case, that convenience might be the most expensive mistake you ever make. Here's what nobody tells you about Bitcoin ETFs. When you buy shares, you own a financial product that tracks Bitcoin's price. You don't own Bitcoin. It's like the difference between owning gold bars in your safe versus owning a piece of paper that says, "I promise you own gold somewhere." One of these you control. The other? You're just trusting someone else. And if 2022 taught us anything, it's that trusting third parties with your crypto is a fantastic way to watch your money evaporate while lawyers get rich sorting out the bankruptcy. But the ownership issue is just the beginning. Wait until you hear about the fees. Bitcoin ETFs charge anywhere from 0.2% to 1% in annual fees. Doesn't sound like much, right? Just a few dollars per thousand invested. Except here's the math nobody shows you. Over 30 years, that 0.5% fee compounds into you, losing roughly 15% of your total returns. You're basically buying a new car for your ETF provider with money that should be yours. Meanwhile, self-custody Bitcoin? One-time hardware wallet cost of $100 to $150 and you're done. No annual fees, no management expenses, no middleman taking a cut every single year forever. But it gets worse because the fees are just the visible cost. Let's say you buy Bitcoin ETF shares today. Tomorrow, you want to use Bitcoin to buy something, send it to someone, or even just move it to a different wallet. Tough luck. You can't. Because you don't have Bitcoin, you have shares of a fund that holds Bitcoin. It's like owning shares in a pizza restaurant but not being allowed to eat pizza. The entire point of Bitcoin is peer-to-peer money that you control. An ETF is the opposite of that. It's asking Wall Street for permission to access your own value. And speaking of Wall Street controlling your access, here's a fun fact. During major financial crises, governments have a habit of restricting access to assets. They can freeze trading. They can limit withdrawals. They can even confiscate holdings. Happened with gold in 1933. Happened with bank accounts in Cyprus in 2013. Could absolutely happen with Bitcoin ETFs if things get hairy. But self-custody Bitcoin? Good luck confiscating something when nobody knows you have it, and you're the only one who can move it. Bitcoin was literally designed to be uncensorable and unconfiscatable. An ETF is neither of those things. It's just another thing governments can freeze with a signature, and honestly, if you think that could never happen in America, I'd love to hear your reasoning in the comments. Because history suggests otherwise, and I'm genuinely curious what makes this time different. But let's talk about something even more immediate than theoretical government seizures. Every ETF has counterparty risk. That's a fancy way of saying you're trusting that the company holding the Bitcoin doesn't go bankrupt, get hacked, commit fraud, or mysteriously lose the keys. Mt. Gox was trustworthy until it wasn't. Celsius was fine until it wasn't. FTX was the golden child until it catastrophically wasn't. Wall Street firms aren't magic. They're just companies run by humans who make mistakes, take risks, and sometimes commit crimes. When you self-custody Bitcoin, your only counterparty risk is yourself, and at least you can trust your own incentives. But here's where the self-custody benefits get really interesting. One of the smartest Bitcoin strategies is borrowing against your holdings instead of selling them. Avoid taxes, keep your exposure, access liquidity when you need it. Except with ETF shares, That's way more complicated. You'd have to use margin in your brokerage account, which comes with different rules, higher interest rates, and the risk of forced liquidation during market hours. With self-custody Bitcoin, you can use platforms like Ledin or Unchained Capital to get loans directly against your Bitcoin at better terms. Your Bitcoin stays in your control, and you unlock value without selling. ETFs can't do that, at least not efficiently. And we haven't even talked about the tax implications yet. Here's something your financial advisor probably won't mention. With self-custody Bitcoin, you have way more options for tax optimization. You can use specific identification methods when selling. You can time your transactions for tax efficiency. You can donate appreciated Bitcoin to charity for major deductions. You can even do strategic gifting to family members in lower tax brackets. With ETF shares, you're stuck with whatever your brokerage reports. Your flexibility is gone. And flexibility in tax strategy is worth real money. But the biggest difference isn't about fees or taxes or even control. Here's the uncomfortable truth. If you don't understand Bitcoin well enough to self-custody it, you don't understand your investment. You're just buying a number that goes up or down based on what other people think. That's speculation, not investing. Self-custody forces you to learn how Bitcoin actually works, what keys are, how transactions function, why decentralization matters, and that understanding makes you a better investor because you actually know what you own. ETFs let you stay ignorant, and ignorance in investing is expensive. Now I know what you're thinking. But isn't self-custody complicated and risky? The biggest myth about self-custody is that it's for tech nerds and cryptographers, that you need to be a computer science major to not lose your Bitcoin. Bullshit. Here's the actual process. Buy a hardware wallet for $100, write down 12 to 24 words on paper, put that paper somewhere safe. Done. You now have more security than any ETF. Companies like Ledger, Trezor, and Coldcard have made this so simple that your grandma could do it. If you can set up a Facebook account, you can self-custody Bitcoin. The perceived complexity is mostly a marketing tool to keep you using intermediaries who charge you fees. Which brings us to the final and most important reason. There's a saying in Bitcoin, not your keys, not your coins. And it sounds like gatekeeping crypto bro nonsense until you understand what it actually means. Bitcoin's entire security model is based on private keys. Whoever holds the private keys controls the Bitcoin. That's not opinion, that's cryptography. When you buy an ETF, the ETF company holds the keys, not you. Which means they control the Bitcoin, not you. You just have a claim on shares of a fund that holds Bitcoin. And claims can be disputed, they can be frozen. They can be worth less than the underlying asset during liquidation. They can disappear in bankruptcy. But actual Bitcoin in your wallet? Nobody can dispute that. Nobody can freeze it. Nobody can take it unless you give them your keys. Look, Bitcoin ETFs serve a purpose. They're great for retirement accounts where self-custody isn't an option. They're convenient for people who just want price exposure and don't care about the actual asset. But for 99% of investors who can self-custody, who have the ability to actually own their Bitcoin instead of just tracking its price, ETFs are leaving money and control on the table. The whole point of Bitcoin was to opt out of the traditional financial system. Buying a Bitcoin ETF is like opting back in with extra steps and permanent fees. If this video made you rethink the convenience versus control trade-off, smash that subscribe button because I break down crypto strategy that Wall Street doesn't want you to understand. And drop a comment. Are you self-custody gang or ETF gang? Because I have a feeling this comment section is about to be spicy, and I'm here for it. The choice isn't between easy and hard, it's between owning an IOU and owning the actual asset. Choose wisely, your move.